Hi, I'm Inder Chen. This is part of the entrepreneurship series, and this is the second installment of startup financing. Last time we discussed different sources for startup financing, including friends and family, angel investors, VC, and eventually through the initial public offering to raise money from the stock market. But we haven't discussed the how venture capital firms work in this ecosystem for startup financing. And this diagram shows the process of venture capital investment. First, a VC firm has to raise money from investors who are here. It could be individual investor or institutional investors, and certainly can be various enterprise as well. And they will find investment target, which are those startup firms, and they will select the one that has the great potential. So they have to do their due diligence to kind of investigate the validity of the firms, the business plan, business model, and the current situation, etc. And seriously evaluate the data they have gathered, and eventually, if they decided to invest, they have to negotiate the contract or term sheet, as sometimes they refer to. And there's a period for incubation, which means the VC firm will provide some kind of advising and networking opportunity to support and nurture the investee company, the company they invested. And they will monitor its business management and try to improve the enterprise values. And the higher the value of the enterprise at the exit, they will be better off. So eventually, through IPO or merge and acquisitions, they will realize their capital gain. They will collect the funds they have invested, usually with some multiple of 3, 10, and certainly it may be a total value as well. They would, once they receive the return from the investment, they would distribute the invested fund back to the investor, hopefully help the investor to make money. And certainly the investor can decide to contribute what they have received from the investment back to the VC funds and to continue to invest to some other target company. So this is kind of the process for venture capital's investment. A new form of fundraising to raise funding to support a startup firm is through something called crowdfunding, and this is get a lot of attention in the internet world. Usually crowdfunding is used for small amount of capital from a large number of individuals. A lot of time they are so-called individual user or investor in order to finance a new business ventures. And crowdfunding usually use social media, crowdfunding website or platform to bring the potential investors and the entrepreneurs together. Crowdfunding has the potential to increase entrepreneurship by expanding the pool of investors. A lot of them are individuals. And the fund can be raised beyond the traditional circle of owner, relative friends, and venture capitalists. The three type of kind of crowdfunding based on how the investor would be rewarded. The first is really just donation. People like the idea and willing to donate to help the idea to move forward. The second is reward based, which means the investors may actually receive the finished products as a return. That's usually the case, or a ticket to the concert if the fundraising is about hosting a concert. And in some cases, the investor may receive equities of the firms, just like angel investor or VCs. Crowdfunding has gained tractions after the launch of Artist Share in 2003. There are a few other crowdfunding sites that become more and more popular, including Indiegogo, Kickstarter, and Micro Ventures. This infographics show the crowdfunding process. You would develop your pitch, you would submit it to the platform. It will be screened, eventually be listed on crowdfunding platforms, and and then the pitch will go live. You would discuss the project idea, your funding's goal, how you're going to use the money that you receive, and then you will set the funding deadline, that when this fundraising cycle will end. And you will also describe the return or reward that you're going to give to the potential investors from the public. So basically, you target the general public, and when the funding beginning time gets started, the funding window will open, and the publics over here will pledge in terms of how much they're willing to contribute. And when the funding deadline has come, there's two possibilities. One is that the project get enough funding, 100% or more funding, they will proceed. And however, if the fundraising event did not generate enough money, did not meet the funding goal, then the funding that you raise from some of the individuals will be returned to them. And certainly they will not be rewarded with actually equity or potential products. Okay, in some crowdfunding platforms, that the project that you propose can keep the money that pledged by the participants when the deadline has arrived. That is a possibility, but you need to make that very clear, and some platform has a different policy. So the funder contribute money to the entrepreneurs, and they would, through the platform, they would engage in some dialogue for the entrepreneurs to answer questions from the potential funders. And eventually, once it's funded, you would issue the returns or the reward as it once you have developed the product and service. So this is pretty much the crowdfunding process. It's a newly developed trend, which is worth paying attention to. And the crowdfunding, by the way, could be considered as a kind of a market test, testing the market potential. Or people really like your idea and willing to donate money to fund it, or willing to invest in return to get your first developed products, or potentially even the percentage of equity. So next, in this table that you're looking at now, we classify the funding source into crowdfunding, angel investor, and venture capital firms. And here, sweet spot referring to the range of the money which typically we try to raise through these three funding sources. The length for getting the money is 90 days to 180 days or 270 days. And the dilution per round, usually for crowdfunding there's no dilution. For angel, sometimes it's 20% dilution, or in this case 20% dilution really means the angel investor want 20% of the equity. Venture capital's investment want 25 to 30% of the equity, which is the dilution for this particular fundraising run. The effort that as a startup firms you have to make to engage in crowdfunding, angel investment, or VC. For crowdfunding, it's moderate, all the way to high for talking to venture capitalists and try to get them to fund your project. And the type of product and service also may differ or determine which funding source you want to target. And certainly for some product and services and for certain startup firms, they would use all three of them. And certainly in private crowdfunding or angel crowdfunding first, and angel investors, and eventually through the venture capital firms. The due diligence you have that someone has to conduct to decide whether to invest in your firms or not. For crowdfunding, it's minimal. For angel investor, it's moderate, and for VC, it's quite serious about the due diligence, so that's considered high. Intrusiveness in terms of the investor, how much they want to involve in the management of the firm. It is to set up some guideline and policy. Crowdfunding, it's minimal. Angel, it's moderate, and VC, it's high. The experience for crowdfunding can be fun. The angel investors are more tolerable, and for VC, sometimes it could be a miserable experience. So there's a talk about Startup 2.0 using the lean investor model. The method is to invest in many startups using incremental investment, iterative development, which really means prototyping, and start with lots of small experiment and eventually filter out failures and expand the investment based on the success. So there are three stages roughly in investment using the lean investor model. Incubators 0 to 100K. The focus is to build and validate the products. The seed round is 100K to 1 million. The purpose is to test and grow marketing channel. The ventures, usually the money you try to raise is between 1 and 10 million. And your purpose is to maximize the growth and revenues. So David McCrew has a lecture on lean venture capital, and there's 3 slides that we're going to kind of borrow from him and list it here, similar to what we have just discussed. First steps is incubate. The purpose is to validate your product and to verify the customer usage. The structured firms 1 to 3 funders, and we're looking for up to 100K investment. The incubator environment may include multiple peers, mentor, advisors. And in terms of the product or service, we try to build functional prototype or the so-called minimum viable products. So from the concept to the alpha version of the product or service is 3 to 6 months. And we try to develop a minimum kind of set of critical feature set and or minimum requirement, and in hope to get it to work. We made kind of set up basic dashboards to measure the conversion rate metrics, etc. And we want to test customers' adoption, maybe 10 to 1,000 users, and the customer satisfaction can be measured from 1 to 10. So in this stage, we want to demonstrate concept, reduce product risk, and test functional use. And so we would develop metrics and filter for follow-on investment. The second step is market validations and revenue testing. The organizational size 2 to 5 person team, and investment we're looking for is 100K to 2 million. We may have syndicate of angel investor or small VC fund interested in invest in this stage. In this stage, we try to also improve products and expanding market at the same time. And we also want to test the revenues model from alpha version of the product to beta version. Takes about half a year to a year. And we want the customer satisfaction to be to be rated from 1 to 10 and to be greater than 6. So we try to get a reaction that from the user, which may say that the product doesn't suck, which means it's kind of useful. It's not as bad as they think. We want to set up A/B testing framework and try to optimize the conversions. And we'll test various marketing campaigns and also try to differentiate different customer acquisition channels. At this stage, we try to prove the solution, its benefit, and also try to assess the market size. And so we will test the channels cost and also the revenue opportunity. Eventually, we will determine the organizational structure and consider the key hires. The last step is revenue validation and growth. Now the company grow to 5 to 25 person team, and then they're looking for 1 million to 10 million investment. And in this stage, we really try to make money. And however, we also need to think about sustainability of the firms. They're self-supported. And the product is moving from beta version to the production systems. This would take 12 months to a year and a half, which is 18 months. We want customers' satisfaction to be rated from 1 to 10 to be greater or equal to 8, which means that your user will say something like, it rocks, this is a great product, and they would tell their friends about it. So you have this kind of evangelist who are actively promoting your product and services to their friends and relatives. So you need to set up marketing plan to select predictable channel and set up marketing campaigns and set the budget aside. And at this stage, we want scalability, and so we'll build infrastructures and establish customer service and operations. We could connect with distribution partners to grow. So at this stage, we try to prove and extend market and try to operationalize our business. And the future milestone after the step 3 is to make sure the system is the ideas, the product and service based on the idea is profitable and sustainable, and also consider the exit options. And Steve Blank and some of his colleagues has developed the so-called investment readiness level and tied that to some of the key concepts in Lean Startup. So the IRL, the higher you are, the more ready you are. So initially, we just want to complete the first pass of the business model canvas, which really looks like this, which has 9 grids. Eventually, you want to estimate the market size to conduct some competitive analysis. This kind of diagram here show the target accessible market and serviceable available market, and serviceable available market, obtainable market, or share of the market. So using the value proposition design, we can kind of verify problem solutions and make sure it's validated. And once you find the problem solution fit, you can go and build low fidelity prototype, or sometimes called minimum viable products. Low fidelity prototype is different than minimum viable product, but it's you started with a low fidelity prototype and evolve that into a minimum viable product, which can be accepted and used by user or customers. You would another level up. You need to validate product market fits. And in level 6, you want to validate the revenue model, which is the right-hand side of the business model canvas. This is the revenue part. And you move another level up to develop a high-fidelity prototype. It's an enhanced minimum viable products. At level 8, you want to validate the value delivery, which means the infrastructure to help you to build the product or offering the service. At IRL 9, we try to identify and validate metrics that really matters. Muraku from Floodgate state that Thunder Lizard, which is our very successful startup firms, are roughly 25 companies per year that exit for $500 million or more. In this case, there are 4 required power that make this company successful. One is you have proprietary technology, and the second is your products very attractive, and also you have a very good company that you have developed, which can be very innovative and also very disciplined in executions. The 4th power is category or market power. Okay, if you're in a certain product category, you tend to have a better chance to be successful. There are some strategies try to help us to gain the so-called market power, which is the last one here. And this is by Jeffrey Moore, who's known for crossing the chasms, which is one of the books he has written. So the strategy to gain market power is try to identify target customer, find compelling reason for them to buy, and also offer the whole products. You try to also build alliances or partners, figure out your sales strategy, your pricing strategy, who are your competitors, and how you position your product and services, and etc. So once you raise a lot of money, the question is how you're going to use the money. and first of all, I labeled this diagram, which obtained from here, based on the business model canvas, various celled canvas. For instance, the device, software, services is consider the value propositions, and you would go through the channel to deliver your product or services to them, and also you would manage the customer relationship. Here we call it demand creations. And eventually you will reach out to the customer segments here, which can be user, pure user, or customer who may be handling the payment. And you need to set up the revenue stream, which is bringing the money into your firm, but at the same time, in order to produce, manufacturing your products, you need to purchase component, raw material. You need to actually engage in some design efforts. Okay, let's talk about innovation and value. Idea is relatively cheap, but when you have an invention, you increase the value. However, even further, you really need to wrap the invention around with a proper business model, which will bring in much higher value. So when early stage company cannot entice investors due to a longer timetable and a lot of resource or cash required for commercialization, and also they prefer to invest sometime in the early stage instead of the late stage. So there's something called the valley of death, which is transition from a product market fit to start actually approaching the market and to grow the company. And this transitional period is actually called the valley of death. So from research to development, potentially transfer of technology for commercial use, and you're launching your products, you would know that you have a successful product if you really look at the kind of the net cash of the accumulated kind of cash flow, which is shown as a curve here. You will find out that this is the turning point when you're turning to profit, which means your net cash flow should be positive. Okay, and so this deep down is considered value of death, which is more about the process of commercializing your products and also integrate that with your business model and have a successful business. This diagram is a little more detailed, which describe various funding source, which we discussed some of them. At the bottom here are stage of venture development, including conduct basic research to kind of have a proof of concept, identify target market, building prototype, and engineering the prototype eventually into production prototype. And this is the product launch, and hopefully you would generate positive net cash flow, so you would go through this valley of death and eventually turn positive. This diagram from the presentations, roughly speaking, map the fundraising phases to the business model development 4 phases. This is customer discovery, and this is customer validations, which is kind of both of them. And then you try to kind of create customers, and for more mature venture initiative, it's really about company building. So here are kind of funding request, and the RM here is the currency code for Malaysia ringgit. So just that's the different currency than US dollars. And at the bottom here, we kind of refer to how long you would kind of stay in this phase before you move to the next or to just retreat. And Ron Conway is very experienced angel kind of VC guru who manage SV Angels. The company has invested in over 700 companies. So which means they have to talk to thousands of entrepreneurs. So they kind of get some insight. So let's see what's his insight. He tried to find out whether this person pitching the idea is a leader, and is this person focused and obsessed by the products. So basically, we want to know why inspire them to invest, to invent, and to develop this products. And as in other fields, good communication skill, persuading power of the founders is considered very important. Let's look at a little bit of innovation math, which is try to get a sense of VC success rate. Some conventional statistic kind of indicate that about 4,000 venture fundable company a year, only about 5%, in this case, if it's 4,000, 5% will be 200 of those will get funded, okay, by top tier VC firms. And among the 20, only 15 of those will someday get to 100 millions in revenue. So if you really look at the formula, it's 4,000 to 200 and to 15, which will actually, in this case, get to potentially 100 million in revenue. Okay. And when company invest in a firm, they always look at the strengths and the weakness of the company. This is kind of like SWOT analysis. However, when aspire to do is to invest in the startup that have really extreme strengths. Okay, any company will have some weakness that need to be taken care of, but it's more important that we invest in the strengths, in the extreme strengths of the company, instead of look at and criticizing their weakness too often. Last, let me just use Guy Kawasaki's 10 points, top 10 points or mistakes of an entrepreneur. A lot of entrepreneurs would paint really rosy pictures, a big pie in the sky, and say if they can get 1%, which could mean a lot of money. A lot of time they fail because they try to scale too soon before they find the product market fit. Partnership is important, but you have to be very careful who you partner with, and without getting potential competition from your partners. We will prefer the startup firm to actually continuously develop their product and services through prototyping instead of just engaging in pitchings. Use just a few slides and use bigger fonts. This is not just for me, but for the general audience. And you should do things concurrently or parallelly. Don't do it serially. And some startup kind of founder believe in total control of the company, 51%, but that's not realistic in the real world. And I know, like Facebook, they have given Mark Zuckerberg some special stocks which can count for multiple votes. That's one way to deal with it. You need to believing in patterns and make sure it's defensible. A lot of companies founders hire people in their own image because they just don't have a lot of experience in other business area. And so a lot of time you try to be friend with your VC's kind of partner. That's just a wishful thinking. We certainly hope the VC can add value, but in reality, they may be so busy they may not pay actually too much attention of your company per se. Okay, that's it. This concludes our video lectures on startup financing. So I see you some other time. Take care and bye bye.